Hi, everybody. My name is Brenda. I'm the CEO and one of the co-founders of Tellor. And today I'm here to talk to you about why DeFi needs better security and oracles than TradFi ever has, and how we can actually achieve that without becoming TradFi. TradFi is optimistic. And I mean, everybody here should be, I think, familiar with what an optimistic system looks like. You can operate and transact very, very quickly. And then disputes are open. Anybody can come and dispute, right? So in TradFi, what ends up happening is because they operate under a closed system, no anonymous party can just come and run away with your money, right? And they can do high frequency trading because they have very reliable dispute mechanisms. Very robust, so robust that they're backed by governments. And if you can't pay the money back, if you spent it already, you can always go to jail. This is an example of a dispute that happened between Lehman and Intel and Lehman and Citi for some derivative products back in 2008. And they didn't actually get resolved or settled until, 7 and 9 years later. And JP Morgan, they had a case of market manipulation from 2008 to 2016, and they weren't actually fined until 2020. This is slow, right? I know that they can do very high frequency trading, and we're trying to compete with that, but we don't actually have this dispute mechanism that they actually have. So as DeFi, it is much harder, everything that we do, because every decision that we make could have irrevocable consequences, right? If you choose a very fast oracle, you might be more subject to manipulation on the asset. If you use a slower one, it could be stale. If you use a market oracle, something, can happen to the actual asset and be more easily manipulated, fundamental or fixed. Also, it could, if you fix something or hard code an asset to 1, for example, for a stable coin, and all of a sudden the collateral completely depegs, you're in trouble again, right? So there's no one size fits all kind of fix for us. It's much harder what we're doing. Because we are operating on an open system and anonymous parties can come and run away with money. And these are just a couple of examples over the last couple of months of things that have happened related to the oracle. Obviously, when you use a single source oracle with low liquidity, it's always a bad idea. And that's exactly what happened with Binance, with the whole Athena debacle. Athena ecosystem operated, you could say, perfectly in its ecosystem with redemptions and liquidations and minting and redemptions versus what was happening in Binance, right? Binance decided to use a very low liquidity, their own order book as their oracle, and that is always a bad idea. And it was clearly shown on what happened just in their market. Elixir, this is a really interesting one because in May of this year, somebody manipulated the price of DUSD on a curve pull on Ethereum. And that curve pull had very low liquidity, but it was a big enough of a trade that had a direct effect on the VWAP that was quickly picked up by the Oracle, reported on Avalanche, Euler, and 530,000 liquidations happened off of that. And then Elixir, some of its collateral came from Stream Finance, so XUSD, Euler, Morpho, and Elixir had hard-coded XUSD to be equal to 1. And what ended up happening when Stream Finance reported a 93 million loss from an external fund manager, their XUSD completely depegged or completely fell apart, right? So their collateral for Elixir was basically worth nothing or worth a lot less than 1 or than it could have been, or then they assumed it would always be by hard coding it to 1. And so then Elixir had a bunch of redemptions because it was hard coded to 1, but nobody could liquidate and have this rebalance properly because it was hard-coded to one. So there is no one size fits all. Moonwell, I haven't seen the full post-mortem on this one, but the oracle or the calculation, it was way, way higher than it should have been. And they also ended up with about $1 million loss earlier this month. So how do we address that? And on these are a lot of other examples that happen over the years of different things that have occurred where now we can see people are trying different things to mitigate this risk, but one size doesn't fit all. And the conclusion of all of that to me is that we need to start seeing this as we cannot say that if we implement one thing, it's going to work and everything's gonna be perfect, right? So we have to look at security in terms of layers. Over the past years, we've seen over and over again that the actual Oracle protocols don't get hacked. The way that people manipulate or hack the Oracle is basically by manipulating the actual asset and taking advantage of the changes in liquidations or markets for these assets. And whenever they're not optimal, whenever they're able to change the dynamics for price discovery, that's when they're able to attack the Oracle. But the actual protocols, no matter who you use, you're gonna have to provide them a definition or a question of what it is that you want. And obviously, if you don't have enough sources for that asset, or that asset becomes delisted over time, you have to continue to monitor what is happening within your definition that can have a direct effect. So you first start off with a proper definition that is robust, hopefully, and then those assumptions you continue to monitor those assumptions over time because they will be tested. And then make sure that you have your Oracle protocol, obviously choose whatever it is that you need, and within your parameters, you might choose anything from a centralized Oracle to a more decentralized Oracle, but it's important that you implement them properly. And then obviously, you should always assume that something wrong is gonna happen with the Oracle, because even if it's not at the Oracle level, we are operating in a deterministic environment once you deploy your contracts, but a lot of what happens within that deterministic environment, it's correlated to something that's completely subjective and at most probabilistic of information that's coming in from price discovery outside of your ecosystem. So always assume that something's gonna go wrong. That's pretty much a rule of thumb. Make sure that you have fallbacks to address when things do go wrong, and things can happen, or things can go wrong when they can come from the bottom up, from the data definition or your liquidity or your sources, or as we saw with the Levana protocol, when the actual osmosis chain was attacked, it was attacked to create a similar situation to what we had on Black Thursday in 2020. So these attackers basically congested the network so that they could control when the Oracle would update and take advantage of that. So it can come from the bottom up, or it can actually come as an attack to the chain. But ultimately, you have to have those fallbacks to be able to protect your users, because ultimately, all the bad PR is gonna come back to you as a founder. And obviously, as last resort, you can always use your community and actually fork your protocol. This is obviously the last thing you want to do. It's a very difficult thing to do. We always say that, yeah, you can always fork, but if anybody has ever tried forking anything, it's really hard, especially with something that's already established. And as I talk about the social layer, I'm sure everybody remembers earlier in the year when HyperLiquid had an attack via the Jelly token, and they decided to overwrite the Oracle input. So in the past, they hadn't really been they hadn't used that type of control, right? But they decided to use this as this specific hack started eating into their own treasury. And that just showed everybody that they had all of this control. That's not, I don't think that's either good or bad. It's a choice that they made, and it's their community. It was lots and lots of millions of dollars where they were at risk. So I wouldn't want to judge them. But that does put into play now, if the government comes and asks them tomorrow, you do this or do that, they have no recourse. They cannot say that they have credible neutrality anymore, in my opinion. And I think that that is a balance that is very difficult to strike, especially if you want to maintain that, or maintain that you are still an open and decentralized protocol. But all this to say that TradFi does not have to deal with the type of problems that we do, because they have a much stronger dispute mechanism. And TradFi has only updated their systems and been able to, or been willing to provide better services to customers now, because DeFi has become so big that it was impossible for them to ignore us. And as I see more and more institutional investment coming into the industry, you see a lot of people really catering to TradFi and shifting how they work, right? And I just like to say that I think ultimately we're going to have something that operates very close to TradFi and actual DeFi. And we need the DeFi because TradFi will not continue to improve if it doesn't have any competition. We saw that for many, many, many decades. They didn't improve. They didn't do anything very novel until we became a strong competitor. And if we just cater to them and not maintain that independent system, they'll ultimately go back to being what they were before, and we'll end up with a bigger debacle and a bigger recession that we saw in the 2008 breakdown of the economy. And with that, that's all I have for you guys. Thank you so much for being on my talk, and